Today we're breaking down GOF, GOF, the Guggenheim Strategic Opportunities Fund. And instead of just talking about yield or headlines, we're doing what most investors don't do. We're putting the numbers to the test. GOF is a high-yield closed-end fund that invests primarily in credit markets, things like corporate bonds, structured credit, and opportunistic income strategies. It's popular with income investors because of its eye-catching monthly distributions, but that also raises an important question. How has GOF actually performed over time once you account for price changes, distributions, and reinvestment? That's where backtesting matters. In this video, I'm walking through real historical data showing total return with no drip, total return with partial drip, and total return with full drip, and how income stacks up against capital erosion. This isn't about hype or fear. It's about understanding what you're really getting when you own a fund like GOF. Income today versus growth tomorrow. So let's pull up the spreadsheet, go back in time, and see what GOF actually delivered. GOF pays big income, but does it actually build wealth over time? Let's stop guessing and backtest it. Welcome back to Simply Money. Today we're testing GOF. We're doing our all-in scenario where we take my full income portfolio and put it in a back test of this fund and see how it would have performed. Now with GOF, we have some serious data here because this goes back to 2008. Most of the funds we've looked at have gone back maybe a year, a couple of them 3 years. SCHD, we went back 8 years. This one, we're going back all the way to inception at 2008. Now, if you like these types of scenarios, feel free to grab a copy of the GOF Drip spreadsheet on Buy Me a Coffee. The link's down below in the description. Here's what the spreadsheet looks like. Right here, you can change the date. So if you don't want to back test it all the way to 2008, you can put a date in sooner. Maybe you started in 2020, or you want to see how it's done in a different time frame. And I know some people are like, dude, nobody has $525,000. Well, some people do, just to be clear, but you're right. Most people aren't going to invest that much. And if they do, they're not going to invest it all in this. So here's the normal disclaimer. This is not financial advice. This is for information and educational purposes only. I am not a financial advisor. I'm an investor just like you. I am showing you these scenarios, these all-in scenarios, just to let you see the data and what they could do. And what I'll do today is I'll do a couple different figures instead of the full $525,000. We'll put some other figures in there just to give you an idea. But the percentages are all going to stay the same. It's just what the dollar amount looks like. You can change that as well. So you can put $50,000, you can put $5,000 in here, whatever you want to do, feel free to do that. And then over here we have a section where you can change the drip amount, how much you're going to reinvest. And we'll show you that here in a moment. But that's the spreadsheet. And why we do this is to give you an idea of what it could do and what it has done in the past. And so for a lot of these income generating ETFs or funds, people don't understand what the power is. And so we're looking at this to see, even with funds that have a price that drops versus those that have a price that grows, and how the distribution changes things. And that's why we're looking at this, and I want you to get a good picture of this. Again, we have a ton of data, so let's dive right into this now. January 28th, 2008 is when we're starting, because that's when they began doing distributions. We're looking at $17.66 for a price range. This is a monthly paying distribution. The symbol here is GOF. That bought us 29,728 shares with our $525,000 portfolio. So we're going to go down through this. We're going to see a couple things here. Again, you have your monthly distribution dates, what the share price was. You can see here early on it dropped significantly, and we'll watch that as we just come down. You see it got down to $9 very quickly that same year, but then it started climbing, got back up to $18 here a couple years later, so you had some nice growth there. Then it got all the way up to $22 in 2011, and we're back up here in 2013. We got up to $23.35, and we keep coming down. You can see that it's just kind of bounced around in that area for several years. Had some dips here. 2016, it dropped down a little bit, and it climbed back up to that $21 range in 2019. Got 2020, we have the COVID era here. In March of 2020, dropped down to $14. It kept climbing back up. So that's a good sign when you see that it drops and follows market sentiment. If the market drops, it drops, but then it climbs back up to its normal range. And then again, we have 2022, the entire market was down. You can see that GOF went down. And then 23, here's where we start having a little concern. When the market rebounded in 2023, GOF didn't seem to have that rebound. So of the last couple years, early on it was really strong. The last couple years, there seems to be a little bit of difference what's going on, and a lot of that has to do with the interest rates, in my opinion. But that is, again, my opinion. It has dropped down, and now you're looking at seeing it at about $12 currently is where we're sitting at. Now, as we get down here to the most recent data in the end of December, we're looking at $12.61. So you can see it has really dropped recently, and over the last few years, it has not regained and rebounded. So this is an iffy situation for me. I'm actually tempted to put a little bit in this because it is down quite a bit, but we will see. I'm going to do a little bit more research on this, but I wanted to present this data to you just to show the back testing of this. And just, again, it's a tool, not just for this fund, but for other funds to understand how this works and the process of distributions and reinvesting them and the power of accumulating that, even with the share prices down 28% over 18 years, I believe it is, we're looking at. That's quite a drop, but we're going to see some amazing things here. Now, the other thing I want you to look at, go to column C, you see the distribution. We started out at 15 cents, 0.154 cents. It was steady at that, did not change until, let's come down here, until 2013. So 5 years, it paid the same exact month over month over month. Then they went up a little bit. Not a lot, but they went up to 0.1694. It did that for a few months, and it went up to 0.1821 cents, 18 cents per share, and it did that until, again, every month, month over month. If you want consistency, this one's definitely shown that is paid consistently up until even most recently here. We'll move this over, 18 cents. It is paid out. You're seeing that distribution for so many years, exactly the same. What's that been? When was it? From 2013. So 12 years has been paying the same exact distribution. Now, if you're dripping, that's great because you're getting more shares, and more shares builds you a bigger payment. But if you're using the distribution, you have to understand, if you're taking the distribution and you're not reinvesting any of it, you're losing buying power. Just remember that, because inflation, you're getting the same distribution over and over and over and over again and not seeing any pay raise. So you're actually losing purchasing power over the course of that time. You may want to consider a small percentage of reinvestment to help offset cost of living. So let's look at this as far as payments. We have a full drip here, and we're going to start with full drip. You're taking that consistent monthly payment for these 18 years. Now, this is to show you the power of long-term investing. For those of you who are commenting and reaching out saying, oh, this fund that you're talking about is horrible. And, we're talking about funds like Chippy or WPay or Ulti, or even like good funds like QQQI. They've only been a couple years. Those are short-term. When you start seeing funds and they've only been around for 8 months or 12 months, there's not a lot of data there. And if you bought into any fund, even the S&P 500 at a certain time, and you look 12 months, you'd be like, oh my God, the S&P 500 sucks. Because say you bought into it the beginning of 2022, and at the end of 2022, you're reaching out saying SPY sucks because it's down so much, because you're looking at a small window. Take a step back and get a big picture of what's going on. Look at these distributions. Starting out 4,578, you're buying more shares. So you see this full drip takes your shares up because you're reinvesting this at this share price. You're gaining a couple hundred shares here, almost 300 shares off of this monthly distribution, because you have 300 more shares and you're getting the same exact payment month over month. You can see before the distribution even goes up at all, by 2012, you're up to $7,800 because you're up to 5,100 shares. You haven't seen a distribution raise, but you've gone from $4,500 up to $7,800 just from reinvesting and getting more shares. So you're getting that distribution to grow. And this is the power of long term. For those who are wondering on some of these new funds, what would happen if I hung in there and stuck with it? I'm not saying all funds are going to do this, so be careful. But look at this. Let's go down to the next couple years here. Go up to 2018. So you've been investing for 10 years. That $4,000 distribution is now a $15,000 distribution. And we're going to see the power that has on your total value. We'll just come down to the end here just to see the astronomical amount after those 18 years that you've been investing and getting distribution. Say, okay, yeah, my share price is down to $12, but I'm getting a $43,000 distribution this month with a 241,000, almost 242,000 shares that are paying me $43,000 a month. That's an incredible yield on cost because of that compounding. So you've had $3.6 million of distributions given to you that you've reinvested. As you can see, your total value over here in column I, because you've reinvested everything. You haven't taken any money, but your value now, portfolio, is valued at $3 million, just over that, because you have been fully reinvesting that and building those shares. Even with a 28% share drop, you've got so many more shares. You're just compounding this. And again, this is long term. Don't be a short-term investor. Investing is long term. If you're looking short term, you're a trader, not an investor. That's my opinion. Take it or leave it. Do what you want with it. Leave your comments down below. What do you think about GOF so far? What do you like about this? And more than just this fund, let's look at this fund as we talk today. This is about getting a better understanding of long-term investing. For my channel, I want you guys to take a deep breath and not always panic on the short term, day to day, week to week, year to year even. Long term, that's where the power investing, compounding takes effect. We'll go back up here. Scenario number 2, we're doing a 50% drip. We're taking half of it. What you see right here, this is half of the distribution, and we're buying more shares. So that shows us the shares that we have now over here. You have your original share amount. You got the 50% distribution, and you reinvested it, so your share count grows. And then you also get this amount to spend. So this is your income. So let's say that in 2008, we retired, we put in this amount. We said we're going all in on GOF. We're going to take half of our distribution, and we're going to live off of that, and we're going to let the rest ride. So you're starting out, you're getting about $2,200 supplementing your income. Maybe that's going with a pension or Social Security, and then you add a couple $1,000s to your income. Let's just scroll down here. Don't mind this one here. This is special distribution. That's why it's so small. You can see that this one's growing, but obviously not near as fast because you're only reinvesting half of the amount, and you don't get that exponential growth as quickly. It does take off, but at a much slower pace. Now, after 18 years, now remember this, you've been living off the distribution and reinvesting half. So you take half and you reinvest half. And here we have, at the end of this time frame, you're getting $7,600 a month, but your portfolio has grown to $1 million. So you've doubled your portfolio. You've basically tripled, almost, over tripled your income, monthly income. So now, instead of having $2,000 a month, you're getting $7,600 a month. Great growth, even with half distribution. Now let's go to this one, the one people look at. We're doing zero drip. We're taking all the income, we're spending it, we're reinvesting in other things, whatever you do with it. We're going to go and pretend that we're retired. We invested all of this portfolio into this one fund. We're getting $4,500 a month from this, and we're going to use that to live on, supplement our Social Security, and that's our income. You're not getting any new shares. So remember that. This is, as you can see, it's the same amount because you get the same distribution here. It's been very consistent, but you're not gaining any shares. What you bought at the beginning is what you get, but you're getting the same income. And then when the distribution goes up to almost 17 cents, you get a slight little raise. So, after, what are we looking at, 4 years there, you get about a $500 a month raise. Now, in retirement, that can be tough if you're looking at that and saying, wow, that's going to kind of suck. 5 years, and then I finally get a $500 a month raise. Maybe you're fine with that. And then you got another raise. Remember, it only lasted a few months and it went up to 18 cents. So now you're getting $5,400. So basically $900 a month after 5 years. And that's a little better. That's a nice little pay bump there. But it has not changed since then. So 12 years, we're looking at $5,400 all the way down here. You can see it month over month over month over month. It has been paying the same exact amount. But in this 18 years that you've been holding this, you've got $1.1 million distributed to you. You've been living off of that, and your portfolio is down slightly. Now you're down to, $374,000. So let's just say at 62, you retired, you threw all that into this portfolio. Now you're 70 years old and your portfolio is down to $374,000 and you're getting $5,000 a month. That's a possibility if that's what you did. Again, I don't recommend going all in on this or any fund. Please be clear on that for those who only watch part of the video, and I'll get comments because they watched 3 minutes and they missed this part. You guys that watch the whole thing, thank you. You come to my defense down there and say, hey, watch at minute 18 or whatever we're at. He said it. Don't go all in on any fund. Be diversified. Get a little diversification. Not saying diversify so much, but you need to have some diversification, in my opinion. So that is GOF and your different drip scenarios here. Let's look at the full drip. Averaged very strong 26% return. That's a nice return. Full drip, if you did this as a growth opportunity, like I'm growing my shares and my distribution, what's going to be when I get ready. Let's just imagine that you did this. Let's say you were 40 and you started this, and then at 58, you say, you know what, I'm going to pull the plug. I'm going to retire, start living off this, hitting $43,000 a month. I don't think you need that much. Let's just say you need $10,000 a month. So you're taking $10,000 and you're reinvesting the other $32,000. Or maybe you say, I'll take half of it, live really good, whatever your need is. But that is if you started way back then. Now, we'll come back to this in a minute. Let's go over here. This is for those that like these drip sheets. If you want to check out GOF, again, you can start it at a different date. Maybe you don't want to go so far back. But what we have here is we put it at 20% reinvestment. And that keeps us just about where we gained about $50,000 over 18 years. So we didn't gain a ton. But what it's doing is it's taking 20% of the distribution. So in this case, it's $900. And you're buying more shares. So it's giving you kind of that pay raise. You're increasing your distribution. So you're keeping 80%. So your first month, you're getting $3,600. So every month, you're basically getting a small raise in this fund through the past because the distribution has been very consistent. So you're adding shares. So, here you got, what's that, a $7 raise each month. You get a $7. Then you got $7 here and $6 there. It's basically $7, and it'll start going up a little bit more. We'll come down here and see it starts going up a little bit more. Now we reach up to $4,000. It's slowly just increasing as we come down all the way to the end. So after 18 years of doing this, you'd be getting $6,500 a month, and your portfolio balance has increased about $50,000. That's where you can take a percentage and figure out how you want to do it with each different fund that you're working with. This one's GOF, and this sheet only works for GOF. For those that are looking at the drip scenarios, the drip sheets only work for the fund that is labeled for because of all the back data that is underneath the formulas. It pulls the dividends, it pulls all that information in from some cells I have hidden over here. So if you put in a different fund here, it wouldn't work because the formula shows for that particular fund. What I want to do for those who have been saying, can you show some real scenarios? I do have videos where I show like $50,000. So I just want to show you, if you take $50,000 and put it in there, it's going to readjust everything. All these numbers change, but the percentage is exactly the same. If you look down at the bottom, these percentages didn't change because the percentage of growth is the same. It's just a different dollar amount. That's why I don't really care what number you put in. I'm doing these scenarios to show, could I live on this? And it gives a feel for how powerful that fund is or how dangerous a fund is when we put an all-in scenario. Again, we can put in, say you're just starting out and you say, what would have happened if I bought this $5,000 back in 2008, all these years? $5,000 may not seem like a ton of growth here, but your portfolio has grown to $30,000. It's not significant, but you're getting $500 a month. You're getting an 8% yield on this, and that's per month, not year. You add that up, that's a nice yield on cost for the year because you're getting $400 every month. If you stop that, you have $30,000, but you're getting that amount. That's a great return on investment for income. Again, it's just a way to play with it and see the different scenarios that you can do. Again, let's just one more quick thing. Let's say I take $10,000, say, you know what, I'm going to do a small investment. Actually, you know what I'm going to do? I'm going to do $20,000, just like the Ulti experiment. For those who haven't watched my channel, check out the Ulti experiment. You can go to the channel, there's a search bar, put in Ulti, and you'll see some of the videos I've done. The very first one I did was showing the experiment starting, and what I've been doing since then is updates. So I'm going to use the same amount I used there. Let's just say that we did that with GOF. It started at $17.66 and now it's down to $12. And I can hear people, look, let's start at the beginning. $17.66. And then within that same year, by November, it's down to $9. I can hear everyone. NAV erosion. This fund's horrible. Bail on it. Get out of it. Now, granted, these distributions have been consistent, so there's a difference there. But look at what would happen with $20,000 if I just stuck it out, rode the wave, rode the ups and downs, just let it reinvest. And 18 years later, I'm getting $1,600 a month of income in a portfolio of $116,000. If you're diversified and this is one small portion and you have other funds, this is a way to help build up your funds for when you get ready to retire. And if you don't have a lump sum, this sheet doesn't show this, but if you're dollar cost averaging, let's say you're putting in $200 a month. When you're starting out, you're getting $200 a month on $17 a share. But here, look how many more shares. You're getting almost twice as many shares this month because the price is down. So that's how dollar cost averaging can help alleviate and help build up funds instead of lump sum. So it really depends on where you're at. So that is GOF. What are your thoughts on GOF? What are your thoughts on this scenario showing the impact of long-term investment? Leave me the comments down below. Thank you for subscribing. If you haven't subscribed, please hit that subscribe and like button. It really helps the channel out. And I will see you next time on Simply Money.